rate, I'll call it nominal. Nominal rate equals 14%. Okay? Inflation. Inflation 5%. That's step 2. Step 3, find the formula. That's gonna solve this problem, right? What kind of formula are we gonna use? Just simple discounted cash flow for this guy, right? So step 3, which is gonna go, well, year 1. So the PV equals negative 1,000 plus year 1, 600 divided by nominal rate 14%. So 1.14 plus 650. Discount 2 years. So 1.14 squared. Step 3. Step 4, solve it. That's it. So the trick here is, it gives you the inflation rate. That throws you off. That's a distractor. Do you need inflation rate in this case? No. So remember, I mentioned, right? Nominal rate, use nominal cash flow. That's a nominal cash flow. It gives you a nominal rate. That's all you need. Don't worry about inflation. So you're gonna use your calculator to do it the quick way. I'm gonna do it the slow way. And let's see, so I didn't look at the answer, so I'm just doing it on the fly. Let's see if I'm gonna get the correct answer. Is that what you guys got? Oh, sorry. Oh, it's gonna block. You know what? No, you won't be able to see. Is that better? I don't know. I'm sorry. 52.6316. No? Did I do an error? All right, well, 600, 650, right? 600 divided by 1.14. Oh, wait, did I do this? Hang on. How did I calculate that? I must have typed something wrong. Sorry. Careless. Let me check my math again. Hang on. 600 divided by 1.14 is 1, 650 squared. Yep. That the answer? Okay, good. So I did it the long way. Again, 4-step process. Timeline, lay out all the parameters, find the correct equation, solve it. But then again, if you have a financial calculator, just punch in I'll do this as well, just in case. Make sure everyone is able to do this. Okay. Right? Okay, so cash flow, second clear work, clear everything. Initial cash flow negative 100, enter. Cash flow 1, 600, cash flow 2, 650, and then NPV, 14% interest, and then compute 26,467. Same answer. Long way, short way. Same answer. Question? Good? Okay. Now that is the nominal way. I'm going to change this question now. Convert. So here's a real interest rate. If I only, same question, but then if I ask you to calculate using the real rate, how would you do this? The real rate. I'll write it on this side. So step one, on line 0, 1, 2, negative 1,000, 600, 650, 2, nominal rate, 14%, inflation, 5%. 5%? 5%. I think it's 5%, right? Okay. So now, what is the real interest rate? What's the real interest rate in this case? Let's go back to the formula. 1 plus nominal rate equals 1 plus real rate. So 1 plus 0 times 14, so that's nominal rate, equal 1 plus real rate times 1 plus inflation, so 1.05. So moving things around. The real rate what do you guys have? Correct? That matches what you have? Yeah? Perfect. So that's a real interest rate. So now, step 3. If I have real interest rate, actually no, before step 3, we're gonna update this timeline because we have now real interest rate, so we need real cash flow. All right? So what's the real cash flow? We're gonna change nominal cash flow to real cash flow. So in that case, I'll write this out. Okay. So this is nominal rate. We're going to convert this cash flow to real cash flow, which is meaning that it should be adjusted by inflation. So I'll make a smaller one. It's cutting off. 0, 1, 2. So the $1,000, do we have to adjust that? No, we don't need to adjust by inflation. The first one, we need to adjust this by inflation. Nominal is 600, so adjusted by the 5% inflation. For the second one, 650. No, you won't be able to see. Put it in a better position. For the second cash flow, I'll write here 650 divided by 1.05 squared. That makes sense? Because we're adjusting this by inflation. So this is now real cash flow. So let's punch this in. 600 divided by 1.05. So that becomes 571.43. That guy 589.57. Okay? So now we have real cash flow. This is nominal. This is real. All right? Any question up to this point? No? Very good. We have real rate, same formula. So we're gonna put them together, but using real cash flow with real rate. So PV equals negative 1,000 plus first year 571.43 divided by real rate 1.0857 plus 589.57 divided by real rate 1.0857 squared. All right? So you can use the financial calculator, that's fine. Why don't you guys use the financial calculator and I'll do the manual way. Let's see if we get the same answer. I'll be careful this time. Okay. Is that the answer you have? Is that the answer you have? Close enough? Okay, so do you notice the two numbers here are very close? In fact, it's only different because I rounded the numbers up. If I didn't round the numbers, these two are identical. So what does that tell you? Doesn't matter. All right? The only thing that you need to know in the exam is if I throw you a curveball, instead of giving you a nominal rate, if I give you nominal cash flow and I give you real interest rate, then you have to convert. If I don't, you don't have to do anything, right? Or I give you real cash flow and I give you nominal rate, then again you have to convert. That make sense? The key here is make sure you use nominal cash flow with nominal rate, use real cash flow with real rate. Either way, it's going to give you the same answer. I don't know why, maybe it's a rounding issue, but it should be the same. It should be the same. It should be it's just a small rounding issue because I'm cutting off the decimal place here. Question here? All right, well, that's going to be a curveball that I could throw you. Just make sure you know how to convert using the Fisher formula, which is provided previously. And again, you can actually see the conversion, right? Remember the approximate? Instead of using the long Fisher formula, you can actually just go 14 minus 5. That's 9%. 9% and 8.567, you know, it's close, but it's not exact because 5% is quite high. But if you change that to 2%, that number is going to get closer to the approximate. Okay. That's the last part I want to show you from last week. And now, what we're going to do is lecture 9. So now we're going to cover applying tax shield approach to the same MMCC case. And then, if we have time, we're going to get into investment of unequal lives. We'll see how that goes. But then more importantly, I want to focus that you guys should read Appendix 8B, the derivation of the PV of CCA tax shield formula. So, how you derive the tax shield formula is going to be important. I'm going to show you how to do it here on the board, but ultimately, here's the thing. If you don't understand everything, that's my job. I want to make sure you understand everything. But the worst case is, if you know the formula, you can just apply the formula. But if you know how it comes from, it's really going to help you and strengthen the knowledge as you go along towards the upper year courses in finance. As a quick reminder, what we went over on Tuesday. Right? We have the company, Majestic Mulch, considering in buying a new machine to produce new products. So I showed you how to create the operating cash flow, investment cash flow. With these two, we would have produced the incremental cash flow, and eventually we can apply a discount rate to find NPV, or we can just straight out calculate RRR. So that was the workflow, and just a reminder, these are the details. The machine will cost $800,000. There's a salvage value of $134,000, and then these are the production estimates of what's going to happen, what's the price of it, and then discount rate, tax rate, and all that kind of stuff. Net working capital we talked about. Initial year $40,000, and then for the next couple years it's 15% of sales, and then the last year is 0. So, to re-jog your memory, I am going to open up the file again. Where is it? Let's do either one. Okay, so this is the spreadsheet that we have. Remember, step 1, we actually went to do the production forecast. These are the production numbers that is given in the case. The price is given in the case. Starting with $100, we projected with 2% increase over the years. Hence, we're allowed to calculate the sales revenue cost is given to you by the case, $64, grow by inflation, 5% increase every year. Then with the production number and the cost per unit, you're able to calculate the variable cost, fixed cost, hence you're getting the operating costs, all right? All in all, you're able to find sales revenue, operating costs. Then, step 2, we're gonna move on to calculate CCA, which is depreciation. In the case, it was given to you, the machine costs $800,000, and every year is going to depreciate 20%. So I showed you how to construct this table. You can see it's a continual depreciation into year 8. What we have there is the depreciation amount year by year, from year 1 to year 8. Going back to operating cash flow, you can just put them here as depreciation. With sales, cost, depreciation, we will figure out earning before interest and taxes. So that's EBIT. With EBIT, we know tax is 40%. Ultimately, we're able to find net income. All right, so that's what we did on Tuesday. Now let's move forward from here. Okay, so in your accounting course, you actually learn the top-down approach and bottom-up approach. I remember asking the fall term, you guys have learned that. Just want to confirm. The fall term people said they know. In accounting, the bottom-up approach, the top-down approach for the income statement. Yes, okay, thank you. I had. Someone, just you, or you guys don't remember? Again, hey, I need to know because I want to make sure that if you don't, I'm happy to remind you. Do you need reminding? Yes? Okay. Don't be shy. Again, I'm trying to help. I'm not trying to tease you. Okay. Top-down approach. we're gonna start from the top. So, as a reminder, okay, this is accounting. I'm kind of crossing the boundary, but if this guy is an income statement, you have every line from the top to the bottom. Revenue, cost, depreciation, tax, and net income. We call this the top line. That's why on the earnings call, what's the top line? Top line is the sales. That's the easiest to understand. Top line sales. The bottom line is at the end, again, in the sales call, what's the bottom line? The bottom line is what's your net income. Okay, the top-down approach is when you construct this income statement from the top to the bottom. You start with sales, you start with then you follow by cost, then depreciation, then tax, then net income. That's called the top-down approach. There's a bottom-up approach. Bottom-up approach is you actually start from the bottom. So what we're trying to do here is to find cash, because in finance, I keep telling you, we care about cash, 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 cash. We want to get rid of depreciation because it's a non-cash item. So from a bottom-up approach, what we're gonna do is we're gonna start with net income, and we just have to add back depreciation. So that's why you have the top-down approach. You just go sales, cost, tax, and you just ignore depreciation because we don't care about depreciation. It's not cash. I don't want to see it. I only care about cash. The top-down, sales, cost, tax. These are the only items that are actually paid in cash flow, correct? Now, the bottom-up approach is that now give me net income, and I'm just going to add back whatever is non-cash in there, which is, in this simple case, is only depreciation. In accounting courses, you're going to get like what? Goodwill, intangible asset, and all that kind of stuff. But in my course in finance, it's a little bit easier. Just net income, add non-cash item. Okay? Two ways, bottom up, top down. There's another way. This is why the tax shield approach will work. So pay attention. Operating cash flow equals sales minus cost. The after tax of that plus depreciation times tax rate. So I'm going to show you, I know at first when you look at like what the hell's going on here, these three equations give you the same answer, which is OCF. That's all we care. It's OCF. What is the cash flow that comes from operations? These three formula would all work, but then why do I choose one versus the other? Finance people are lazy. All right? Finance people are lazy. I want to do things the quick way. I don't want to go through all the numbers, all the different paperwork to find my answer. I want to find a quick way. So it depends. And in your accounting course, you will learn whether you do a top-down or bottom-up. It really depends on what information is available to you. What is easier to do? Sometimes it's easier top-down because if I have a simple case like that, there's only 3 lines, right? I don't have any other costs and other things I gotta remove, so top-down could be easier. But if I have a very complicated case, a lot of non-cash item, a lot of things that I wanna remove from OCF, then I may wanna do a bottom-up, simpler approach. But then we're gonna introduce this, the third way, this tax shield approach, is because it's the lazy way, it's the easy way, all right? And I promise you, there will be at least one question, long question, on the tax shield approach. So under the top-down or bottom-up approach, the projected cash flow are calculated for each year separately with the non-cash items such as depreciation that would add back each year. So either way, if you use the top-down or the bottom-up, remember, you need to calculate this guy, this tab. Because you're dealing with depreciation, you need to figure out every year, each year, what is the depreciation amount. So if we're lazy, let's see if we can skip this part by using the tax shield approach. Okay. The tax shield approach simplified the process I showed you on Tuesday. The one I showed you, it took at least an hour to do the whole thing. Now, can we simplify this to make it a little easier? So we're going to use the present value formula. So remember the 4 formulas that I showed you weeks back? Perpetual, growing perpetual, annuity, growing annuity. So we're going to use those concepts. Now, the OCF is broken up into 2 parts. Here's important. The first part is we assume that there's no depreciation. Imagine that I run a business that there's 0 depreciation. The world is simple. Then I can just go, how much unit did I sell? How much revenue I get? What is the cost? And I just have to pay tax and I'm happy. There's nothing else there. Very simple case. But most cases, I need to have machinery, I have to have equipment, so there will be depreciation. But I want to remove depreciation, right? However, when you see this formula, I should say this formula, when I have depreciation, my EBIT actually included depreciation. And the tax that I pay based on EBIT depends on how much depreciation I have. Imagine if I have a lot of depreciation, I can actually bring my EBIT down to close to 0. In that case, I pay no tax. So accountant can actually manipulate the amount of depreciation to actually manipulate how much tax they pay. You get that? The more depreciation, the more expense it is, the less tax I pay. So depreciation is actually a tax shield. That's the concept. Meaning that you could actually pay less tax by imagining this cost because it's not a real cash flow. So that is the that is the tax shield. And I wanted to show you. All right, that is the amount of tax you could have saved depending on the depreciation that you have for that year. So depreciation tax shield, aka the tax saving from depreciation. You gotta add that back because if you don't add that back, it's not incorrect. It's incorrect, right? You want to have an accurate prediction of OCF. So the new approach now, from the top, it's the same. Incremental cash flow is OCF plus ICF, which is the same as Tuesday. But the OCF part, we're going to have a different approach. We're going to use the tax shield approach, which will break down into the first part, assuming that you don't have the depreciation, and then the tax benefit you get from having depreciation. So it's going to break into 2 parts. The ICF part is the same. Change of net working capital plus equipment expenditure. That's going to be the same. The only difference is the OCF, instead of doing production forecast, doing CCA table, and then doing the whole income statement, and then constructing the OCF, we're gonna shortcut that a little bit. All right, so let's start with the OCF. So remember, there are 2 parts. I'm gonna write notes, break in 2 parts. The first part is sales minus cost times the after-tax rate. Okay, so I have a template which I provided to you if you would like to open it. Should I do it from scratch? I think I should do it from scratch. I think you guys learn better by doing that. Okay, so let me download this, the blank one. You can open this, it is in Quarkus. You guys can download this file. Enable tax shield. Okay, so now it's blank. The tax rate is 40%, discount rate, let's assume, what do we assume? 15, okay, let's assume it's a 15% discount rate. So sales revenue, operating costs, you still have to do the production forecast. That's from the previous table, so we can just copy this from what we had from before. All right, so now sales minus cost times the after tax, so equal sales, I should use brackets, sales minus cost times 1 minus tax rate, which is 40%. I'm just gonna anchor that guy. And I can just drag it across all 8 years. Done. That's step one. Super easy, right? Step one. Now, step two. Let's go to the slides. Okay, step one done. Now, part two. There are two ways to find present value of depreciation tax shield. Calculate manually using the table. All right, the table in the textbook. So, which is this guy. This guy. This guy. You can use the TCA table to calculate depreciation. Every year you have depreciation, so you can actually find the tax on depreciation and then do a present value of that. You can do that. That's a long way. We don't want to do that. So what we're going to learn today is the present value of the CCA tax shield formula. All right, it may look scary at first, but it's just plug and play. So let me reassure you. I'm going to explain how this comes about. Again, it's important to know because it ties back to the concept that we learned in week 4. So again, the CCA is the depreciation expense. It's a non-cash expense. The tax shield, what is tax shield again? It's the tax benefit you get because you spend money, hence you pay less tax. So that tax amount based on this non-cash expense is going to be a benefit to you. We need to find the present value of this benefit. Since we know that the CCA is going at a 20% rate of the remaining value, so technically it's a growth rate, but it's a negative growth rate of 20%. Now we can treat this as a cash flow problem. Remember that guy? What is this? What do we call this again? What? Growing perpetuity. Great. Sorry. Yes, growing perpetuity. That is the formula for the growing perpetuity. But normally what we see, right, in the past, we are used to seeing a growing perpetuity that looks like that, correct? That's a growing perpetuity. But now, it's the same idea, but the growth rate is a negative rate. So hence, we're seeing this. But the idea is the same. We can still treat it as a growing perpetuity, and we can use the growing perpetuity formula to do that. However, what's a growing perpetuity again? What is the time horizon for a growing perpetuity? Forever. Very good. Is this case forever? No. This is an 8-year. So hence, it's a growing perpetuity with definite term, meaning that is? Yes. Yes. This becomes an annuity. So how do we do that? Remember how we actually change the formula for annuity? How do we actually derive the formula for the annuity? All right, so as a reminder, annuity goes forever. Forever, right? If I only care about the first 8 years, how do I calculate the annuity for the first 8 years? Is that I would calculate the entire thing, the value of the entire thing, minus this tail part that goes on forever, correct? And that would leave me the first 8 years. That's how you calculate the annuity. And we will apply exactly the same concept here. Okay. If we want to find the present value for the first 8 years, we find, which is the first 8 years plus the remaining life. So we will find the present value of the first 8 years, and then we find the present value for the remaining eternity. that equals the whole thing, right? This is the 8 years, this is for the remaining. Moving it around a little bit, if we want to know what's the present value for the 8 years, then we just find the entire thing minus the tail. Again, that's a conceptual thing, it's a theoretical thing. If you don't know this, just use the formula. But if you are able to follow along, wonderful, because that's how it comes about. Okay? Now, here's the 2-part. For the entire life of this thing, the formula, again, this is a growing perpetuity. So CF K minus G. However, we will actually change some of the wordings, all right? The cash flow, which is the original price of the asset times the CCA rate for the asset class times the tax rate. So that's really, we're just modifying one equation to these specific terms, just because to match the case. For you, write that on your cheat sheet. I know it looks scary, C, D, T, C, but it's all there, all right? It's just finding the information and plugging it in. That's all it is. The present value in the disposition year, so this is the PV after 8 years. So let me draw all these together so you can see this better. Okay, so remember, why does it look like this? Why does it look like this? What are we trying to calculate here? These are tax benefit, all right? So these are good for you because of depreciation. This is the tax that you actually save. You would have paid, but because you have depreciation, so it's a benefit to you. But it starts to diminish. Why is that again? Why is that tax benefit diminish over the years? Anyone? It's a fundamental concept. I don't want to rush this. I want to make sure you guys understand this. So I'll take the time to explain this. First of all, yes? Yeah, because of depreciation. So remember this guy? The machine started off at $800,000 and 20% of it is being depreciated every year. So the depreciation amount is decreasing over the year. You have the most depreciation in the first couple of years. It's like buying a car, right? You guys know, buying a new car is actually kind of stupid because the first year is going to depreciate the most. By the time, after 10 years, the depreciation amount between 10 and 11 years is almost like nothing. But the first year to the second year, gosh, like that's going to drop the most. So the depreciation expense is the largest in the first couple of years, hence your tax benefit is the largest in the first couple of years. Does that make sense? And as it continues to go on, depreciation amounts start to diminish and your tax benefit will continue to diminish. That's why it looks like that. So I want to make sure that you guys understand that first. And then, all right, so here, let's say this is times 0, and we're going to draw a line. Let's say this is year 8. This is where we care. All right, this is 8. Now, we figured out how to calculate the whole thing, right? The whole thing. I'll take a step back. Looks like you guys are struggling a little bit, but I will slow down and repeat. We'll take a. This is an indefinite, all right, forever. Forever. It goes on forever. If I want to find the present value of the whole eternal thing with the tax benefit here, the equation that I use, because this is the whole life, we're going to use a growing perpetuity. right? This is a growing perpetuity. So the formula is cash flow divided by K minus G. What is K? What is K? Discount rate, very good. G? Growth rate, very good. So the first step, I'll break this into multi-step. We'll take a break after this, okay? I promise. First step, calculate the entire thing using this formula. But because of this specific case, we're just gonna substitute some of these numbers, okay? First of all, the cash flow. What really is the cash flow? The cash flow is the tax benefit of depreciation. So it is the original price of the asset times the depreciation rate times tax. That's really the tax benefit. So cost of the machine times depreciation rate, all right, times tax. Because this is the tax on the depreciation of the machine. That's why that's really just turning into that. And this guy, what is K? K is still the same K, which is the discount rate. But why do we change it to plus D? Why did we change it to plus D? What is G again? Growth rate, great. So in this case, what is growth rate? Minus 20%, because it's not growing, it's actually dropping. So G is minus 20. So basically, is K minus 20. So really, that equals K plus D, which is the depreciation rate. So that's why there's a plus. So it really is minus G, and G is a minus, so plus D. Again, I want to explain all the nuance to you so you understand where this come about. Again, I hope you do get it. If you don't, just write on a cheat sheet. You'll still be fine. You can still get 100%. But if you understand this, it's going to make it so much more easier and more enjoyable. Okay? So why don't we take a 10-minute break? But please, meanwhile, if you have any questions about this point, let me know, and I'll further explain this. Okay. Midterm, anyone? Midterm? Midterm? No? Okay. Yeah. Oh, you need your midterm. Okay, yeah. All the questions, again, please, I continue to encourage you guys to ask a question. It makes me happy. Whenever you guys ask a question, it tells me that, it's not your problem. Maybe I can do a better job in explaining. So please keep those questions coming. I mean it when I say I really do appreciate any form of question. So a few questions came out with what we have here. The question is, wait, I thought this machine was only lasting 8 years. Why are we considering like an indefinite timeline? What's going on here, right? So I want to bring you back when we talked about perpetuity and annuity in week 5, all right? So the concept is, we first have to understand what is a perpetuity. The perpetuity is cash flow that is constant forever, all right, forever. That we understand. And we have a simplification formula to calculate the present value at time 0, assuming that we have an infinite cash flow. That's fine. Our case is only 8 years. We only care about the first couple years. Why do we have to care about the infinite amount? The reason is because simplification, this is how annuity came about. Let's say, if in this simple example, if I only care about the cash flow, 1, 2, 3, 4, if I only care about cash flow for the first 4 years, So let me ask you this question. If I consider from now to forever, is that a perpetuity? Yes. From year 4 to forever, is that a perpetuity? That is also a perpetuity. So an annuity is essentially a perpetuity minus another perpetuity. So that's why we have to find to perpetuity to get the annuity. All right? So let's take a look at the two timelines. One is from now to forever. All right, from now to forever. So the second timeline, that's from now to forever, right? And we're gonna call that PV0, okay? And then the other one is going to be from year 4, so year 4 to forever. Correct? That's also perpetuity. That is PV4. So, what is an annuity? An annuity with a definite term, which is here, is essentially the PV of the whole thing minus the PV of the tail. That makes sense? So, equal PV0 minus, so now, this is called PV4, correct? But you have to be able to minus them in the same reference point. So what we're gonna do is we would have to discount PV4 back to today's value. In that case, the annuity is PV0 minus PV4 discounted by 4 years. So that is an annuity. So the question was, well, I thought we were only dealing with a machine that lasts 8 years. Yes, but if in order for us to calculate the annuity, we need to know what's past the 8 year, which is the tail part. We need to figure out the whole thing, so then we can then eventually get what really is the PV for those 8 years. That make sense? Okay, I'm glad you guys asked. Again, those took the questions. Any concerns here before we continue? So what we did here is really looking at the entire thing. All right, that's the entire thing, life, entire life. So that's the equation for the life. What's next then? What's next is to figure out the tail. The tail after year 8. That's the next step. So let's go to the next step. That's the tail. After 8 years, all right? So which is the salvage value times this depreciation rate times tax, K plus D. So it's the same formula, but instead of the C, which is the initial cost, the tail after 8 years, we use the salvage value, and then all the way to the end. So that's the tail end. That's step 1. And we have to discount it back to now. So that's the step. We have to discount it back to now, depending how many years, in this case, 8 years. So hence, salvage, depreciation, tax, that's the tax shield cash flow, K minus G, because G is a negative, right? Just depreciation rate, so it becomes K plus D, times discount, 8 years. I'll leave this here for a minute, and I'll open for question. No? No? Okay. Where do I begin? Where do I begin?
Why is the salvage
Why is the salvage? Very good question. Okay. Why is the salvage? So, in a non-growing perpetuity, right? This is just a constant cash flow. We just need to know what's the PV here and the tail end. So we can just plug in the cash flow because we know what that cash flow is. It didn't move. But because this is a moving, so you need to know at the end of the life, what is that cash flow? You would just use salvage, right? Because that's the end of the life. And you know it's 134,000. So 134,000 and continue to depreciate for the rest of forever, that's the tail. Is that clear? Good. I'm glad you asked. Anyone else? I know there are questions. Otherwise I will get 100 in B10. Instead everybody failed B10 last term. No, I swear everybody. The average was fail. I can't believe it. Okay. All right, that's part 2. I'll continue. Think of your questions, and I swear I'd rather not teach till the very last. I'll leave time for you guys to digest, ask questions, go back and forth, make sure you understand the entire process. Okay. Now, step 2, right? We have to bring it back to year 0. So that's the tail end after discounting, putting everything together. We have the first part, which is the entire life minus the tail. That results with only the 8 years of present value of this tax benefit. That's just putting everything together. I know, you think this is scary? Wait till you get to like the next level. But again, it's scary. It's only multiplication and plus and minus. It's not even like differentiation or integral here, right? And it's just plugging things in, all right? What is C? Original cost of the asset. D is the depreciation rate. T is the tax rate. If you list everything out correctly, just plug everything in and it will work. Again, even if you don't understand what's happening so far, plug everything in the formula and it will work. Yes?
Is there a way to do this in financial calculator? Or
No, unfortunately, no. Yes. Unfortunately, not. The reason is, let me see. Can you do this in the financial calculator? No, simple answer is no, sorry. Yeah. Okay. Okay, so now here's the example. Remember I said step 1, timeline, step 2, list out all the parameters. If you list out all the parameters like that, cost of the project 800,000, lifetime 8 years, depreciation rate 20%, the resale value 134,000, K, which is discount rate 15%, tax 40%, plug everything in the formula and you're done. That's it. Right? If you don't understand anything I just talked about for the last hour and a half, plug everything in. And you will still get the answer as the person who sits next to you who understands everything or pretend to understand everything. Alright? So that's it. Plug everything in, you get the number. So that is the PV of the tax shield. Okay. So let's see what's next. Hang on, let me see how I did this. Sorry, give me 1 second. Just reminding myself what I missed. Did I miss anything? Okay. So that's the tax shield part. Going back to the big picture, how do we start from here again? OCF plus ICF. OCF, we already got that out of here in the first part, very easy. That was the one that we spent most of the time on, really finding the PV of the tax shield, which is based on that formula. Just plug everything in and done. Again, if you list everything out, apply the formula, what, 3 minutes? Most? You got that one done. This one actually takes longer because you have to do the production forecast and everything else. So you got now the entire OCF. You got the entire OCF. Now let's move on to the ICF. Okay, OCF, part 1. Go back to my tax shield tab. Right, sales minus cost times 1 minus tax. So we can actually find the present value of that. That's 682,000. Now here's 682,000 plus 172,844. Where did that come from? 172,844, which is from the formula. So that's really OCF. So you can see, again, the argument here, the OCF is supposed to be faster, supposed to be quicker because you use the formula. Done. You don't have to do the CCA table and everything else. It's faster than what we have done on Tuesday. And then now, moving on to the ICF. ICF is exactly the same. There's nothing changed. You have your net working capital year by year. You have the change in net working capital year by year. Equipment, salvage value, find the overall investment cash flow, and then you can find the present value of the ICF. So the present value of the ICF is 845,000. So then now put everything together, right? Incremental cash flow equal OCF plus ICF. OCF 855, ICF 845. So in the end, incremental cash flow is a positive $10,000 based on a discount rate of 15%. Yes, we accept the project. Too quick? Okay, let's take a step back. Incremental cash flow equal OCF plus ICF. We get that. ICF part we already talked about on Tuesday. Any question about ICF? Change of net working capital, equipment, done. So the only difference that we have today versus Tuesday is the OCF. The OCF, we have a new approach called tax shield approach. We're going to use this general formula. We're going to break it into two parts. First part, assuming that there's no depreciation, which is sales minus cost times 1 minus tax. How do we do that again? As a reminder, we do our production forecast, and we simply calculate this by sale minus cost times 1 minus tax. We have all these cash flow from year 1 to year 8, and we just find the present value of that. You can use a financial calculator, you can use Excel, but that's the present value of that first part. The second part, depreciation times tax, that's the tax shield. Sorry. Excuse me. The tax shield is based on the formula. Again, if you don't understand how it's being derived, just plug in the formula. The formula looks like this. This is what you want to have on your exam. Okay, one thing I wanted to point out. Excuse me. Excuse me. All right. The formula here, for those eager students who are actually going back and doing past exams and past case, you would notice that it has a slightly different formula. And the answer that you calculate will be different. I have to make it very clear. Professor Ahmed has been using the older textbooks, so his test has a slightly different formula. Why? Because the tax shield formula in the past used something called a half-year rule. It's a half-year adjustment that is actually defined by the CRA, the Canada Revenue Agency. That no longer applies. No longer applies. So since 2 years ago, this is it. So good news is this is actually a simpler formula compared to the previous half-year. So if you go back, the older textbook, older questions, you have a slightly different formula. If you go with the textbook that I assigned to you, and if you go with what I'm telling you here, this is the correct answer. All right? This is the correct answer. Make sure you notice that. Again, tax shield formula is just plug and play. List out the list of the input that you need, plug everything in there. You don't even need a financial calculator for this. Just plus and minuses and multiplications and divisions. So after all that, you have your first part of the OCF, you have the second part of the OCF, you have the OCF. You got your OCF, you got your ICF, you're happy because you have your incremental cash flow. Once you have your incremental cash flow, you already know whether it's positive or negative, and you can actually come up with a decision immediately. Does that help? Any questions? No? Okay. Now we have a case called the LTM case. Where's the case? Is it the quickest? Let me double check. So I'm trying to remember, where did I put this LTM case? Solutions, nice. Oh my god, where did I put this? Must be missing something. Just give me 1 minute, sorry guys. Well, think about it for now, and I'll find the LTM case. That's just another example that I can show you how this is done. Okay. See here. Okay, I must be going crazy. Sorry guys, I don't remember the LTM case. Why am I missing it? I didn't attach it, right? Where's this guy? Okay, I'll give it to you guys later. I honestly don't know why it's missing. Okay, well, you know what, guys? Let's don't worry about the LTM case. If I find it, I'll do a recording. I'll show you how this is done. I don't remember why I don't have the case somewhere. But let's see, what else? Okay. Got a little bit of time left, so I'm going to talk about the equal lives. Remember, so far, everything, the decision that we've made is we have a project and we have to decide whether we would invest in a project, yes or no. We do the cash flow comparing if we would have invested versus if we wouldn't have invested. However, there will be a case where you actually have a decision to make whether to invest in A versus B. And most of the time, if I ask you, okay, we've got two options, whether it's going to be a new ice cream machine or a slushy machine. We would assume that they would have equal lifespan. Let's say that ice cream machine was expected to last 8 years. The slushy machine will also last 8 years. That's what we call equal lives. Then I can do a scenario. I can project, how many ice cream or slushies I can sell, how much it's going to be, cost, revenue, tax, and everything. Same procedures that you would do, and you will be able to compare the incremental cash flow to see which project is more profitable. So the idea here is to extend. Instead of investing in a new project, we have a decision to replace. So I already have something that is working, which is an old machine, an old ice cream machine, slower, but working. I have a decision. I have a brand new machine that's going to be faster, producing more ice cream, but is it worth replacing it? So it's the same idea how you would do it in the previous steps, but the steps are a little bit different. So step one, find the NPV if the old machine is replaced by the new machine. So think about it. If I'm going to replace an old machine, what's going to be the investment cash flow? Anyone? What do I have to do? Just logically, what a logical person would do. I have an old machine, I'm going to replace it with a new one. How does the investment cash flow going to look like? What's going to happen in year 0? Anyone? A new machine? Yeah? Yes, you sell the old machine. Thank you. You sell the old machine, there's a salvage value for the old machine. You buy a new one, and it's going to cost you money. And then at the end of the life of the new machine, that's going to be sold. So that's the difference between a new project versus a replacement project. A replacement project, you have to sell the old machine, assuming that is worth something, and then you have your costs. So step 2. Now you're going to find the net present value if the old machine is not replaced. What does the ICF look like if the old machine is not being replaced? Anything happen in year 0? Nothing. Nothing. Same old machine. I don't need to spend $1 on it, it's still working. And then, let's say it has 8 years left, then I have a salvage value of the old machine. So I'll repeat this again. There's a good chance, hence how I feel, I may put in a replacement question. A replacement question is going to be one notch harder than a new project. Because a new project, nothing is new, it's just new machine, that's it. A replacement project, you have to compare 2 scenarios. When have I replaced the machine versus what if I don't replace the machine? If I replace the machine, I can sell the old machine, buy a new machine, and sell it when this is done. Not replacing the old machine, just nothing spent in the beginning and you sold it when this is done. Understand? Okay. So here's an example. The existing equipment has a current value of $2 million and a salvage value of $300,000 after 10 years. This is existing. This is existing. The new equipment can be purchased for $5 million and have a salvage value of $1.5 million after 10 years. The new equipment will reduce net working capital need by $500,000 immediately and will increase before tax operating revenue by $600,000 a year. The CCA is 30%, tax rate 40%, and the recovery rate of 14%. Should the equipment be replaced? That is an exam question. That is an exam question. So this is going to be a little bit harder, all right? A little bit harder than the previous one. So step 1, find the net present value of the new machine replacing the old machine. Is this the one? Hang on. I think this is it. No. I wonder where this is. Okay, so in this case, the first step is to replace the old machine. So you would imagine in the ICF, you're going to have a new spending of $5 million in year 1. However, you're going to sell, not year 1, year 0, but you're going to sell your existing machine for $2 million. So you have an inflow of $2 million and an outflow of $5 million. And this machine has a lifetime of 10 years, so then by the end of year 10, you have a value, a salvage value of 1.5 million year 10. So that's what the ICF would look different. However, there are a couple of things you need to pay attention to. We mentioned here in the case, the new machine will reduce net working capital because it's more efficient. It will reduce net working capital by 500,000 immediately and will increase before tax operating revenue by 600,000 a year. So you have to be able to put this in a table, all right, and calculate the present value. So two parts. If it's going to reduce net working capital by 500,000, what's the change of net working capital in that case? Yeah, what's that? Again, the new equipment will reduce the net working capital need by 500,000 immediately. So that's a positive cash flow in the change of net working capital, all right? And then for OCF, how's that gonna change OCF? It says here it will increase before tax operating revenue, so that's sales minus cost, increase by 600,000 a year. After tax, you can do the tax, right? And then you have CCR, you have discounted, so you can use the tax shield approach to actually calculate this. Let's see, what else is there? Okay, so here's the step-by-step. Find the OCF. Step 1. You know what, hang on, I just wanna make sure that I should have time to show this. You know what, let's do this. We have enough time, 15 minutes, let's do this. Let's go through this example. If I go through this, I can put this on the exam. So let's do that. Unless you ask me enough questions that you can delay me. That's the incentive here. Questions? All right, let's go. All right. ICF. All right, let's start. I'm going to do it by hand. I'll show you how to do it by hand. 15 minutes is going to be a challenge. Let's see if we can do this. ICF, year. Let's do this. 0, 10. All right, I don't need to write every year. So year 0, if I have a new machine, I'm going to buy a new machine. The new machine is going to cost $5 million. I'm just going to go in the thousands, okay? And I'm going to be able to sell my old machine for $2 million. Happy? Year 10, I'm able to sell it for 1.5. Okay. This is ICF. What's the present value of ICF? Can we do this? Yeah? All right, let's try this. I got 15 minutes, I gotta try. Okay. Cash flow. Clear everything. The initial cash flow, plus 1500. Okay, enter. Year 10, how do you do that? Smart way to do it, 0 for year 1 for 9 times. Right? 9 times. 0, 0, 0, 0, 0, 0 for 9 years. And then the next one, 1500. Enter. Alright? Or do it by hand. It's easier to do it by hand. Just discount it by 10 times. And then net present value of that, interest rate, 14%. Compute. Oh, what did I do? Compute. One nine. Okay. So another way to do this, right? Do it by hand. So 10 year, discount that, 1500 divided by 1.14 to the power of 10. So 1.14 to the power of 10. Flip it upside down, times 1500. And then the first year is $5 million. Yeah, 5. Sorry. $5 million. So negative 3,000. I'm careless, man. I rush. Glad you checked. Maybe it's just right in here. Okay, so the present value is 2111. Okay, that's the present value for ICF. You can do the cash flow. Can't believe I made that mistake. Enter. Just checking my math. Someone check my math, please. Keep doing this one. I think that's consistent. Yeah, that's consistent. Okay, so that's ICF. Let's move on to the next one. Now we gotta do ICF of the net present value. Oh, that's true. That's for equipment, PV or equipment. Now we have change in net working capital. The change in net working capital, because it says in the case, it would increase immediately or release 500,000. So 500,000. Okay, so all in all, the PV or ICF equals then, let's go OCF. OCF has two parts. The first part is sales minus cost times 1 minus tax. Okay, because it says it will increase before tax revenue by 600,000. Before tax revenue, 600,000. All right, every year. So if we have year 0, 1, 2, 3, all the way to 10 years, and every year we're gonna have this increase. So that's basically 600, oh, sorry, here's 600 times 1 minus tax. So for 10 years straight, you're gonna have that. So what's the PV of that? PV of sales minus cost, 1 minus tax. What's the PV of that? You got 10 years of that. So 600 times, tax is 30%, 0.7. So that's 420,000 every year for 10 years. All right, we can use the cash flow calculation again. Cash flow, clear. No initial cash flow, but every year. For the next 10 years, you have 420. 420, I see, 420, right? And for 10 years, frequency 10 years. Enter. Cash, NPV, interest 14%. Compute 2190. Okay? So that's the first part. Now we're gonna move on to the second part. The second part, this guy. For the interest of time, I'm not gonna write everything out, but it's there on the board, and I'll explain. Same formula, this is a tax shield approach. The equation, you just have to write it on the cheat sheet. The challenge is to identify every single input here. Original price, $5 million. It's there. Salvage, which is 1.5 million by the end of the life. D, which is the CCA rate, 30%. No, 40%. CCA 30%. Tax rate. You guys don't remind me. Come on, you guys are tricking me. Tax is 40%. Tax is 40%. Tax is 40%. So this is I use 30%. Sorry, guys. 360. So cash flow 360. 10 times MTV. That's a challenge. You gotta read the question right, because I don't. That's why I keep making these mistakes. Okay, so CCR rate is 30%, tax is 40%, K 0.14, and then again depreciation rate 30%. So simply plugging everything in. That's really it. Just plugging everything in. That's the to replace. Okay? I'm not going to write that out because it's there. ICF already did. Okay? Now, to not to replace. That's a not to replace. So what happened when you're not replacing? What's the tax shield for that? Old machine, still fine. You know, it's $2 million. It's worth $2 million today, and eventually it's going to scrap for $300,000. It's going to last 10 years, so that's the present value for the tax shield if I don't replace. This is the existing machine, and now I'm going to add everything together. Okay. Let's find. This is to replace. This is to replace. Let's add everything together. To replace. ICF minus 2095.38 plus part 1 of OCF 188,187.80, all right, plus the tax shield, which is from here. No, that's a whole machine. This guy. Find it. 1253.2. Okay. Stop there for a second. What is this? This is ICF. Because I need to buy a new machine to replace it, it's negative. Make sense? That's from there. This is OCF. Remember, I broke down OCF into two parts. That is sales minus costs times after-tax rate, which is there. That, what is that again? Tax shield approach, right? Tax shield approach, right there. So I have ICF, I have OCF, what do I get? Incremental cash flow. So now, this is the incremental cash flow for replacing. Let's punch this in. Okay? Okay, so incremental cash flow. Okay, it's a positive. Now, we're not done yet. That's to replace. We're comparing it to without replacing. Without replacing. So what is without replacing? Not to replace. We're almost there. Give me 2 more minutes. Replace. Okay, we're going to do the same thing. ICF plus OCF. What is ICF? We would have to calculate the ICF, but we already paid for the machine. So the only thing that I have for ICF is the salvage value that I get from the old machine. So we would have to calculate the old machine is worth 300. How much is it worth? $300,000. All right, but the 2 million is already paid, so I don't have to put the 2 million in here. So ICF is really 300,000, right? Discount the salvage value, that's it. OCF, with the old machine, is there going to change in net working capital? No. Is it going to change operating profit? No. But it would actually give us tax shield approach, so we still have to include the tax shield approach for the old machine, which is here. All right, that's the tax shield for the old machine. So the first part is 0, and the tax shield is 523. 523.39. Okay, so let's finish this. I know. Almost there. Okay, so the incremental cash flow for not replacing, for keeping the old machine, is that. Now we're done. To replace, we have an incremental cash flow of 1 million, 1.35 million. To not replace, we have 604,000. Which one is a better deal?
Not replace.
Which, that is to replace, that is not to replace. Which one is a better deal? To replace, because you want higher incremental cash flow. That's it. All right. Again, please review this. I will give you more questions to practice. I told you this is hard. I'm not joking. This is why last term most people fail. It's honestly, it's just the matter of doing it. Okay. Again, if you don't understand any of the concept, just at least plug in the formula. Understand the operational matter of it. Put it all together, and it would work. All right. The good news is, I know I'm late. Good news is. Hey, we'll make a deal. Last term, I also covered unequal lives. We'll skip that. All right. I want you guys to focus on the equal life. I want you to do well. So at least, I'll cut it in short. All right. I'll spare you with the unequal life. I'll keep it a little simpler, but I really want you guys to do well with this. Okay. So thank you guys. I'll see you guys next Tuesday. We're gonna have a new topic. That's it for capital budgeting. That's it. Next week's gonna be a new topic. So enjoy the weekend. Make make sure you catch up with your work. There are end of chapter practices that you can work on. Midterm tests still here, whoever needs to pick up. Otherwise, see you guys next week.